Sorry, I should have been clear. I mean, would it be possible to take a meeting off, for example, and then resume? Could you, rather than just doing at every meeting a move, go a little bit more slowly, take some gaps in between moves?
I mean, I think this is not something that the committee is thinking about or exploring in any kind of detail. In principle, though, we used to do was go every other meeting, if you remember, 25 basis points, and that was considered a fast pace. So I think a lot of options are available, and you saw what the Bank of Canada did, and they left it that they're willing to raise rates after pausing. But this is not something that the Federal Open Market Committee is on the point of deciding right now.
Did the Fed just lie to us? In February, they said that pausing and then hiking at subsequent meetings was off the table. But this highly conflicts with what we just heard from them at the most recent FOMC meeting. So let's talk about what happened at the FOMC meeting and the SEP that we just got from the Fed. Hey everyone, it's Jonathan here, and let's get right into it. So at the FOMC meeting, the rate decision was to keep rates steady at where they are, and it was selected off of a unanimous vote. And this makes sense given a lot of the weak inflationary data that we got, like the CPI and the PPI, the days leading up to the FOMC's decision. The CPI headline number was at 4.0% year over year, and the biggest takeaway from that report was that shelter still is playing a massive role in disinflation. It was the biggest inflationary anchor at the beginning of the year, but now it's starting to actually become the biggest anchor to push inflation down. And private shelter cost data, which tends to lag the CPI data, shows the trend is continuing. Then another trend that we're starting to notice as well is that the year-over-year numbers are starting to trend down as well. I said this in the last video I made before the FOMC meeting, that what the Fed is more concerned about is the year-over-year numbers and not so much the month-over-month numbers, just given the volatility that inflation does have from a month-to-month perspective, even with just core itself. So it's really hard to pull a trend from it. When it comes to PPI, the headline number was an increase of 1.1% year over year. And what we're starting to see with the PPI report is that core goods PPI inflation went flat year over year. And that service PPI inflation is continuing the downtrend that started at the beginning of the year. So with all of this, it only made sense for the Fed to pause and to not hike this at this meeting. Now moving on to the summary of economic projections that we did get from the Fed, they signaled that they do see 2 more rate hikes happening before the end of this year. The last SEP that we got in March showed that the current Fed funds rate was at its peak. And the only explanation is that it could either just be a straight pause where we are now, kind of what happened, or it could be that the Fed will hike one more time and then cut. And either way, we would get to that number at the end of the year. But even though there's 2 more rate hikes baked into the SEP for this FOMC meeting, the new SEP did forecast more cuts in 2024, with it forecasting about 100 basis points of cuts in 2024 versus the 75 basis points of cuts in the last SEP in March. This new SEP also projected that we'll get more GDP growth by the end of the year and a lower unemployment rate compared to March's SEP. So when we move on to the dot plot, we saw that there was more of a convergence to the median rate estimate of 5.6%, where about 9 out of 18 committee members agreeing to this number, which is the most convergence we've seen in a very long time on the dot plot, probably throughout even this whole hiking cycle that we've been on. And I think that was mostly because of the fact that the Fed did leave the door open to hike in the future, but also left the door open to this pause from here as well. So because of that, that made a lot of members on both the dovish and the hawkish side a little bit more comfortable with kind of coming together on that number. Even though those numbers are not really supposed to be commingled with one another, like they don't collude to make that number. They're supposed to make that number independently of their own data that they have on hand. So moving on to press conference that we got after the release of the SEP. The Fed for pretty much this entire hiking cycle has said that they don't want to repeat the mistakes of the 1970s. And one of those mistakes that happened in the 70s was the starting and stopping of rate hikes. And this kind of goes back to that clip that we started off this video with, where Jay Powell was talking about how it's kind of off the table for them to pause one meeting and then hike in the very next meeting after they've been on this entire consecutive hike run that they've been on. So it's almost like this meeting contradicted the February meeting a lot. In the press conference, Jay Powell was asked, why did the FOMC pause and then signal 2 more rate hikes this year? And Jay Powell started off by saying that it was a part of slowing down the rate increases as they get closer to restricted levels. So for those of you who remember, at the end of last year, we're at one point having 75 base point hikes on a meeting-to-meeting basis. And then it slowed down to 50 basis point hikes, then 25. So pretty much what Jay Powell is saying is that now you're trying to go from 25 to maybe skip, then another 25, then skip, then another 25, trying to slow down that pace of how fast they hike rates. And this question was kind of reiterated by Nick Timiraos, or also known as Nicky Leaks, who's kind of considered to be like the mouthpiece of the Fed. And when he asked this question, Jay Powell actually slipped up and he suggested that this pause was actually a skip. And then he tried to correct himself and say decision. And a lot of people in the media are making a big deal out of this, because when you compare this with also the fact that later on in that same meeting, he also said that July FOMC meeting will be live. And pretty much what it means when it's live, that means that there's a very high likelihood that we'll get a rate hike. So it's a very interesting little slip up he had there, but it also does give us a lot of insight into probably what we'll see in the meeting minutes for the FOMC. And we'll probably see some discussion of a rate hike in the July meeting. Something else that Jay Powell was asked was about the upwards revision to core PCE and GDP and the downwards revision to unemployment rate on the SCP. And Jay Powell stated that all of these adjustments were just getting back to pre-Silicon Valley bank collapse levels. Pretty much what he's trying to say is that a lot of times where the small bank failures were a really big player in the economy, it was mostly seen as isolated incidents with banks that were just mismanaged, not necessarily a crumbling of the entire system. And because of that, the Fed wanted to get back to those levels because that's where they felt like it was appropriately restrictive. And then they also stated that getting core PCE back to 2% will be a very long process, and we're only in the beginning of that process. And I thought that this was really interesting because it does highlight a very big dichotomy between the market and the Fed. So the Fed tends to look at PCE, or personal consumption expenditures inflation numbers, whereas the market tends to look more at the CPI, or the consumer price index inflation numbers. And right now the CPI is falling rapidly, whereas the PCE is actually almost, you could say, flatline for the past 4 or 5 months. But it is still trending down, but it's just not moving down at the rate that CPI is. So even though the market's out here cheering that inflation's coming down, the Fed actually isn't, because they're not really seeing it on their side with the PCE. So I think some takeaways from this meeting is that overall this meeting was just very hawkish. Even though the Fed did pause on the rate hikes, it seemed like almost they were being very hawkish because they wanted to kind of keep the genie in the bottle per se, and keep the market under control and not have everything go very euphoric and maybe even undo some of the work that they've done on inflation. Initially, when I was first hearing the FOMC press conference live, I thought that the Fed was just being hawkish just to keep the market down, even though they did pause. But honestly, after reviewing it some more, it seems like they honestly just want to slow down the pace of rate hikes, and they really want to take their time before they make a decision on what the next hike is. So it's not so much of they're being hawkish just to kind of keep the market under control. They're being hawkish because that's like actually how they feel, and that's actually what they're trying to do. So I wouldn't really be shocked if they come out and they hike in July if inflation data starts to flatline more like it has been over the past couple months. and we don't really see significant progress being made. But given that just today on Friday, we got the University of Michigan Consumer Sentiment Report, and that we saw the one-year inflation expectations fall from 4.2% to 3.3%, it's a good signal that the data that we get over the next month might push the Fed to just pause in the following meeting as well in July. And I would be really shocked if the Fed does actually reach their SEP target rate at 5.6% and hike after the July meeting if inflation does stay on this downwards trend. So that's basically all I got for you guys. Thank you so much for watching. As always, please like, share, and subscribe, and I'll see you in the next one. Peace.